Between mass layoffs and people quitting or changing jobs, there are a lot of people looking to roll over their old 401ks right now. And with that comes questions about the best way to do it without screwing yourself with penalties and taxes. Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're answering questions we've been receiving about rolling over a 401k into an IRA, whether it's a traditional or a Roth IRA.
Yeah, we're getting a ton of questions on this subject, and especially in the comments of our videos.
Yeah.
So keep them coming because you guys are doing a great job. And while you're at it, hit that like button and don't forget to subscribe to the channel.
Absolutely. All right. So, Brian, let's just get to it. Let's start with the two options for rolling over a 401k into an IRA, and that would be the direct and indirect options.
Yeah, these are the main two options. And we'll start with direct first because this is normally what happens. Okay, so a 401k direct rollover occurs directly between the trustee or custodian of your old 401k plan and the trustee or custodian of the new plan.
Okay.
You never actually receive the funds or have control of them. So a trustee to trustee transfer is not treated as a distribution of assets to you. So, and you can roll directly, Michelle, roll over to an IRA, a Roth IRA, or a new annuity, or even your new employer's 401k directly.
Okay, let's talk about indirect then.
Indirect. This is the type of 401k rollover where you actually receive a distribution from your retirement plan. And then to complete the rollover transaction, you must make a deposit into the new retirement plan that you want to receive the funds. You must complete the rollover within 60 days of the date the funds are paid from the distributing plan.
Okay, big question that we've been asked a lot lately is a 401k rollover to a traditional IRA taxable?
Okay, it depends on the type of rollover. Okay. So let's start with taxes are not due on a direct rollover from a 401k to a traditional IRA account. And since the funds transfer directly from custodian to custodian, there's no tax consequences. Okay, so that's the direct way. Now, let's go back to the indirect way. Taxes will be withheld from every indirect rollover of 20%. That's mandated. Okay. And indirect rollovers when the custodian sends you the rollover check in your own personal name. So John Smith receives this check from his old 401k plan minus the 20%. Okay. Now you have 20 days to deposit it into your new IRA account or maybe an old IRA account that you already had. In this process, IRS mandates that the custodians withhold 20% for taxes. After the taxes are taken out, you are sent the remaining funds by check. That means that if you want to roll over the entire distribution, you'll need to come up with that extra 20% from your other funds. So like checking, savings, or whatever. Sure. Now you'll be able to recover them withheld taxes when you file your tax return. But if you fail to complete the rollover or miss a 60-day deadline, all or part of your distribution may be taxed and subject to a 10% early withdrawal penalty unless you're age 59 and a half or another exception applies.
Okay, so what if you want to roll over your 401k into a Roth IRA? What are the tax consequences there?
Okay, you can directly roll your 401k Roth provision to a Roth IRA with no tax consequences.
Okay, what if you don't have the Roth provision and you want to roll your 401k into a Roth IRA? Then you have to pay the taxes, correct?
Yes. If you don't have the Roth provision and you roll your 401k into a Roth, you will owe income taxes on the money you roll over from a traditional 401k plan to a Roth IRA for that year, but you'll owe no taxes on withdrawals after you retire. So that's the benefit of going into the Roth. Okay. And here's why. Remember, with a traditional 401k, your money goes in pre-tax. Roth IRAs are funded with after-tax dollars. Sure. This is why you'll be taxed on the conversion dollar amount.
Okay, so going back to what you're talking about with the indirect, where plan providers will mail a check in, say, like Susan Smith's name, right?
Mm-hmm.
So when 401k plan providers mail out the check, like to Susan Smith, what's her next step?
Okay. First of all, depends on what she was trying to do with it. If she was running through her advisor and is going to mail it to the new company, or it just might be they set up their own brokerage account online, they're going to mail it to there. You need to contact your advisor or the company who you're rolling the 401k to. Let them know you have received the check and where you need to send it. It's critical you follow the instructions given to you by the company you're setting up the IRA with, and whatever you do not endorse the rollover check.
Okay, why is that? I mean, it's in your name, right?
It's in your name, but here's the scenario. The companies will allow you to deposit it into your account without you endorsing it, okay?
Okay.
But here, you'll need to send the check to the new custodian where the IRA is. For safety reasons, honestly, you don't want to mail an endorsed check anywhere today.
No.
Please don't do that.
It's been so long since I've had a check. I've forgotten about the security of that.
Well, and it's funny, Michelle, I get this question all the time. As a matter of fact, yesterday, a client's account with an old 401k rollover, she had got the check sent to her, but it was written in the new custodian's name for her benefit.
Got it. Okay.
And that was still her question. Do I endorse the back of it? No, you do not. So the only time that you would endorse the back of the check is if you were keeping that distribution and you were not mailing it to the new company.
Okay. All right. So I'm going to shift gears here a little bit. Another question we've been receiving is, does a 401k rollover count to an IRA count as a contribution?
No, you haven't contributed any new money, as these funds were already contributed in the past. You can still contribute your max amount to the new IRA for the year.
Okay. All right. So before we wrap up, is there anything else you want to add?
Well, whatever you do, make sure you don't leave your old 401k behind unless you have a specific reason to do so. There's many reasons not to forget about them, but there are some instances where it does make sense to leave them behind.
Okay. So when does it make sense to leave it behind?
Okay. First of all, this has to meet your goals.
Okay.
So, and if you're between the ages of 55 and 59 and a half, you've left that place of employment that your old 401k is at. Okay. So if you're following them guidelines, you can use the 55 and separate from service rule, leave some or all your assets at your previous employer. And think about this, Michelle, if you need access to your funds, you can access them penalty free. You will still pay taxes on the amount, but no IRS 10% penalty during the specific time frame. Okay. I won many new client accounts knowing this rule.
Sure.
Where an advisor tried to get them to just roll the account over. And one big institution said, just roll it over. It's no big deal. Except for they need access to these funds. And a portion of these funds. And it created a tax consequence for them.
Sure.
And
that would have been unnecessary.
Yeah, exactly.
Yeah.
So
okay. All right. Well, there you have it. Here's the thing. If you are wondering whether or not you should continue to fund your retirement, we are going to put a recent video we did in the pinned comment below and also the description. Do go check that out because I know a lot of people are asking that right now, including myself. So it's a great video we did. Also, don't forget to hit that like button, subscribe. If you have comments, if you have questions, leave them below. This entire video was made based on questions we received. So
exactly,
send them below if you got them. All right, Brian, thanks so much for the information, and thanks to everyone who watched.
Thanks everyone. Have a great day.